Thank you so much, Dean Triantes, for that very kind introduction. And thank you to you and your colleagues for inviting me to join you at this important forum. Good morning to everyone. Very pleased to be here with you this morning. I'm sure we're all very pleased to see the focus on Africa, and certainly to have some Africa-like weather doesn't hurt this morning after an interminable winter. It's really an honor to be given this opportunity to talk to you about the most recent macroeconomic developments in sub-Saharan Africa, to say a bit about the prospects for growth in the region, and to speak a bit about the critical role of private investments in enhancing them. I always cherish the opportunities like this one to engage with young professionals on sub-Saharan Africa. It's a long way from where I was when I went to graduate school in this country. The interest you see among young people about sub-Saharan Africa, as we've heard from Dean Triantes and from Kislaya. It's what will actually push institutions in this country to do better in terms of more work and more exposure of their students to the region. And so every opportunity I get to help to push that forward, I do by engaging in discussions like this. And most recently, I was at Harvard at a 9th annual conference on Africa development that students across 5 graduate schools at Harvard have been putting together for the past 9 years, and it's really a really great opportunity to see what young people are thinking. It's not a bad thing, of course, to engage with people over the hill like myself, so I'm not saying I only want to talk to young people. So I think reflecting what was really a noteworthy evolution in the development finance landscape, there's quite a bit of focus these days on leveraging the balance sheets of the multilateral development banks, MDBs, and of development finance institutions, or DFIs, with private capital in support of the Sustainable Development Goals. There's much talk of the role of blended finance, as it's called, that is using official development assistance to supplement the traditional DFI model of investing on near market terms with concessional finance. And some of my colleagues at the Center for Global Development have been, in fact, working on these issues and initiatives lately as part of our Sustainable Development Finance Program. And there is now little dispute that high-quality private investment can indeed fuel growth, and that these initiatives can be catalytic of such investments. And all this is very good. But what I want to focus on today are the conditions under which these investments can materialize and actually be most productive in unleashing growth. And I want to situate this against the backdrop of what has been weak economic growth performance in the region over the past 2 years. So the full title of my speech is, in effect, Investment Fuels Growth, Leveraging its Impact on Sub-Saharan Africa's Growth Prospects, with the subtext being that this only really happens with appropriate policies. So I'll begin by first reviewing the region's recent growth record. I'll then discuss some key macroeconomic and structural policies for attracting private investments and sustaining growth. And I'll close my remarks by commenting on the respective responsibility of Sub-Saharan Africa's private and development partners in supporting the region's search for durable growth. So to start, a few words on the region's growth. After close to 2 decades of robust 5% plus growth and the associated Africa Rising narrative that we heard so much about, performance in 2016 was alarmingly poor, with negative per capita income growth for the first time in 20 years. And although improved, growth estimated for 2017 was really barely enough to avert another year of shrinking per capita incomes. And a further uptake in growth is projected this year and next year, but momentum is still weak. The commodity price shock and regional oil exporters' delay in responding to it explain much of the poor performance, in addition to South Africa's economic stagnation amidst its difficult politics. But these average growth figures mask the diversity of economic performance in the region. A number of non-resource rich countries, for example, the Côte d'Ivoire, Senegal, until last year, Kenya, have continued to grow robustly, albeit with increased vulnerabilities that I'll speak about shortly. So that's in a nutshell what's been happening on the growth side. But what of the future? And will Africa Rising still be the story? Notwithstanding the recent weak average growth performance, Sub-Saharan Africa's long-term growth prospects continue to look good. And that growth potential is clearly at the source of the strong investor interest we still see, and that gatherings like this one can promote. I'm sure that the policy and practitioners panels, as well as the luncheon keynote later today, will throw a lot more light on that potential. But the region really must redouble its policy efforts to realize that potential and to better exploit new opportunities in the global economy and to reap its much heralded demographic dividend. It must now embark on returning to a path of durable growth with a two-pronged focus by continuing to implement corrective macroeconomic policies in oil exporting countries on the one hand, and on the other hand, by initiating fiscal consolidation to address the worrisome vulnerability of increased debt levels in non-resource intensive countries. Let me now comment in more detail on three sets of policies supportive of these 2 points that I've just sketched out. The first is an emphasis on revenue mobilization. The second is addressing debt vulnerabilities, and the third on policies to foster improved competitiveness and economic diversification. Domestic resource mobilization has actually received quite a bit of attention since the 2015 Finance for Development Conference in Addis Ababa. And there's been a strong consensus that it is the most sustainable development finance. There's indeed significant potential for raising tax revenue, especially in oil exporting countries. For example, at only 6% of GDP, Nigeria's tax ratio is the lowest in the region, and most certainly doesn't reflect its tax potential. The IMF estimates that the average sub-Saharan African country could increase its tax to GDP ratio by 3 to 5 percentage points, with the potential in oil exporters being the highest at 8.25%. And while the region saw the largest increase worldwide in tax revenue since 2000, at about 18% of GDP in 2016, a median tax ratio continues to be relatively low. The good progress made in increasing revenues in sub-Saharan Africa will need to be sustained if, in the face of limited aid, rising borrowing costs, and debt sustainability concerns, if the region is going to make further progress in filling infrastructure gaps, and in building human capital, all that with a view to, of course, attracting more private investments and meeting other development needs. So moving to the second set of supportive policies, there has been rightly increased commentary on sub-Saharan Africa's debt vulnerabilities in recent months. I think you've seen articles here and there, including in The Economist, talking about this, and of course institutions like the IMF speaking about this more and more in recent months. Debt stocks have risen rapidly throughout the region, but especially in oil exporters. While also inching upwards, they've increased less rapidly in non-resource intensive countries and in other resource intensive countries. An increase in the debt level is in and of itself, of course, not a bad thing. But the pace of debt accumulation we've seen in recent years is indeed worrisome. The sharp rise in debt stocks in the region is largely driven by fiscal deficits debt service costs have increased, especially for oil exporters and other natural resource producers. In Zambia, for example, in 2011, interest payments on debt were about 20% of the money spent on health and education. But by 2017, they had risen to 50%. Nigeria's debt service has increased from 22% of revenues in 2016 to more than 60% in 2017. And from only 7 in 2013, the number of sub-Saharan African low-income countries in debt distress or at high risk of debt distress increased to 12 in 2016. And several countries with sovereign credit ratings have been downgraded. So while there is good news for containing debt in countries' plans for fiscal consolidation, implementation of such plans is often postponed. And stronger recovery and safeguarding debt sustainability certainly requires steadfast implementation. Fiscal consolidation is of course, often easier pronounced than achieved and can harm growth if it's not designed and implemented appropriately. But there's encouraging research, again, from the IMF that has shown that when accomplished through increased revenues, the fiscal consolidation required for containing debt is less damaging to growth in the region. But of course, ladies and gentlemen, returning the region to a path of growth requires not only corrective macroeconomic policies. Many of the factors that had propelled growth since the mid-1990s have ended or are receding. Apart from better macro policies, these were higher aid flows, debt relief, record high commodity prices, and the uptake in global liquidity from advanced countries' unconventional monetary policies in the aftermath of the global financial crisis. So I'll now spend some time highlighting needed structural policies to improve competitiveness so that it can become a key driver of sub-Saharan African future growth. Competitiveness was, in fact, not a significant factor underpinning the growth momentum from the mid-1990s. Again, this is an average picture. So, of course, there were some countries where improved competitiveness was a driving factor in growth. But overall, for the region, this was not the case. And the last 15 years actually saw a loss of competitiveness in the region, especially in commodity exporting countries. Improving the region's competitiveness by further trade liberalization and by addressing needed reforms in the financial sector and in the business environment are critical. So are high-return infrastructure investments to help reduce private investment costs. We'll learn more about the business environment from Albert Zofak's keynote address, I believe, in the next session. So let me not dwell on that, but instead say a bit more about addressing the infrastructural deficit and about trade and financial sector reforms. And much has been written about and said about poor infrastructure as the key constraint to investment, to private investment and growth in sub-Saharan Africa. And addressing it has indeed been a key focus of African policymakers and of their relationships with development partners over the past decade. I know this from my 8 years, leading the IMF's African department, when financing infrastructure was really what dominated our policy dialogue, and how to do that while maintaining debt sustainability. I also lived that, of course, as Liberia's Minister of Finance in the immediate aftermath of our devastating civil war, when infrastructure was non-existent after that period of war. But here again, we're likely to hear more about infrastructure, I think, from Albert's address. So rather than repeating the facts and enumerating the many challenges in this area, I only want to stress the need to ensure that infrastructure is financed in a manner protective of the domestic revenue base and of debt sustainability, while mitigating fiscal risk. I should first note that protecting the revenue base is essential because domestic resources, tax and non-tax revenues, but also domestic borrowing, domestic resources constitute and currently provide the bulk of financing for infrastructure in the region, and increasing them will remain the best means of doing so in the future. I want to, however, be clear that managing debt levels, with manageable debt levels, countries can and should borrow to expand needed infrastructure. But doing so in a sustainable fashion requires the maximum use of concessional financing by countries with higher risk of debt distress and low institutional capacity, as well as rigorous priority setting and cost-benefit analysis to select the highest return investments. And these critical elements of improved public investment management are also necessary in countries with lower risk of debt distress, who may consider more non-concessional financing. Now, after domestic resources and external borrowing, the third source of infrastructure financing is public-private partnerships, or PPPs, which are attracting many countries in the region. While there's clearly significant potential for increasing the envelope for infrastructure investments through PPPs, but poorly designed PPPs can result in contingent liabilities, often in the form of guarantees to private partners. And mitigating the associated risk requires carefully assessing, disclosing, and budgeting for those risks. And significant strengthening of institutional and legal frameworks is necessary to benefit from PPPs, including a strong, clear role for the Ministry of Finance. With that said on infrastructure, I'll move next to the region's global and regional trade integration. Sub-Saharan Africa's trade expanded rapidly. You heard Kisela say some things about that. It's expanded rapidly over the past 2 decades of high growth, with a significant increase in goods exports between 1995 and 2013, when the export to GDP ratio rose from 20.5% to 27.5%. And the region's export destination also shifted significantly from advanced countries to emerging markets, with China becoming the single most important trading partner. But when seen against the rapid expansion of global trade over the same period, Sub-Saharan Africa just barely maintained its share of world trade. And when using the measure of centrality in global trade, in the global trade network, with centrality measuring and covering not only the size of exports, but also the number of trade partners and the relative weight of those trade partners in global trade, when using that measure of centrality, Sub-Saharan Africa is still the least integrated region. By almost doubling its share over the past 2 decades, developments in regional trade have been more impressive. Although at only 15% of total trade, intra-regional formal trade in goods is still below other regions. Other regions estimated 17% in Central and South America, 42% in North America, 62% in the European Union, and 64% in Asia. More progress has been made in some regional economic communities, such as the East African Community, the EAC, and the West African Economic and Monetary Union, or the WAEMU. And some countries are already focusing on leveraging their comparative advantage and integrating into global value chains, and have been successful in that regard. Ethiopia, Kenya, Seychelles, South Africa, Tanzania, they're making good progress there. And the recent signing of the Continental Free Trade Area Agreement by 44 countries is a welcome development, obviously, that holds promise for greater regional economic integration, provided, of course, that Nigeria and South Africa, the region's 2 largest economies, do eventually join. The increased interconnectedness expected from these developments can best avert the risk of negative cross-border spillovers if Nigeria, South Africa, and Angola, the three largest economies accounting for 60% of sub-Saharan Africa's economy, if those countries pursue more sustainable growth-enhancing policies. But notwithstanding its two-decade trade expansion, the region continues to trade below its potential. Reduced tariff and non-tariff barriers, improved access to credit for the private sector, better infrastructure, better business environment, all of those can position the region to seize opportunities in global trade more effectively. Ladies and gentlemen, I know that at a time of increased protectionist pressures in this country and in some other countries, this is a more difficult message to give to African policymakers. But it is one that remains nonetheless pertinent. Trade openness helps spur the region's past growth and can certainly continue to do so in the future. Let me now briefly discuss policies needed to improve the private sector's access to credit. I think it's especially important to highlight this issue in the context of rising domestic public debt that has further increased the bank's exposure to the sovereign in some countries and reduced room for lending to the private sector. So this disturbing development has resulted in declining credit growth to the private sector from an average of almost 19% in 2011 to 2013 to 11% in 2014 to 2016. And there's been a contraction in real terms between March 2006 and March 2017. So at a time when, of course, there's a lot of talk at the policy level about attracting more private investment, you see a decrease in the amount of credit that is possible for the private sector because of what's happening with public sector debt. There's some evidence pointing to this type of crowding out in Angola, in the Central African Economic and Monetary Union countries, and in the Gambia. So well-orchestrated fiscal consolidation needs to be pursued in countries with crowding out to permit more lending to the private sector. The removal of benefits that provide excessive incentives to hold government securities and implementation of macroprudential measures to limit the large exposure to the sovereign may be necessary in some countries. And financial sector reforms such as property titling and credit bureaus to facilitate information will help to encourage diversification of the bank's portfolios towards more private lending. One impressive development in the region's financial sector in recent years has, of course, been the rapid rise of the Pan-African banks, with the scale of their operations now larger than those of traditional European and American banks in the region. But to reap the full potential of Pan-African banks in expanding the private sector's access to credit and to mitigate the risk of negative spillovers, measures to strengthen cross-border consolidated supervision and to safeguard and manage risk also need to be implemented in a timely fashion. And as is widely known, and again, Kislaya spoke to this, innovative financial services such as mobile banking has expanded the access to a larger share of the population. But small businesses and female entrepreneurs continue to have very limited access to credit. These inequalities can be addressed through the introduction and strengthening of the appropriate enabling environment to further broaden financial inclusion and by supporting more bank competition. Given the impact they can have on private sector confidence, it goes without saying that legal and other reforms needed for strengthening institutions and improving governance are also critical for attracting investments in new sectors as required for diversification. Ladies and gentlemen, all these policies I've discussed in the past 15 minutes or so are essential to the region's objectives of attracting more private investments, of structural transformation, and of diversification. As has typically been the case when confronted with low commodity prices, there has been quite a lot of talk lately about diversification since the 2014 oil price shock. Diversification does indeed offer the region a path to durable growth, but only and only if attention to it in fact outlasts the shock. Having said that, the policies I've sketched do not imply a one-size-fits-all recipe for sub-Saharan Africa. Getting the policy mix right and playing to individual countries' strengths is important for fostering diversification. And that's evident in the different approaches pursued with some success in Mauritius, in Burkina Faso, in Rwanda, Uganda, Botswana, but with all of these countries adhering to macroeconomic stability while taking different approaches based on their own strengths. So I've spoken at some length about the responsibilities of sub-Saharan African policymakers in their search for increased levels of high-quality investments. I want to now turn to how the region's partners can help, starting with its development partners, be they international financial institutions, the IMF, the World Bank, the African Development Bank, or traditional bilateral or new bilateral partners. The region will need continued policy advice, as well as financial and capacity building support from its development partners to both deliver critical public goods that governments are best placed to do and to facilitate increased private investment. But the specific need will, of course, differ by country. The IFIs and traditional bilateral partners must continue to demonstrate agility in responding to the region's evolving needs. I think good recent examples of such responsiveness are revisions to the World Bank's and IMF's debt sustainability analysis and to the IMF's debt limits policy to, among other things, reflect the new kinds of financing risk that countries are now facing, and to facilitate more non-concessional financing while maintaining debt sustainability. Another example of responsiveness, I think, is the G20's Compact with Africa, which aims to catalyze increased foreign private investments in countries with good policies. And as we all know, another major partner for sub-Saharan Africa these days is China, which has certainly been agile and is frequently praised for being responsive to the region's needs, especially in infrastructure, in recent years. China's One Belt, One Road initiative can potentially further expand infrastructure investments with private sector financing, although debt sustainability implications, again, will need to be watched. And that said, China's voice could also be more strongly heard in urging continued policy adjustment and reform in sub-Saharan African oil exporters to contain debt to manageable levels. Debt is now unsustainable in several countries where China is the largest creditor, and its full engagement with countries on these issues will be critical in finding workable solutions. Beyond this, the broader international community has the important role and responsibility of advocating against the protectionist and inward-looking proclivities we see here in the United States in order to create and safeguard a global environment more supportive of private investment and strong, sustained sub-Saharan African growth. So let me conclude my remarks by highlighting some of the private investors' responsibilities in ensuring growth-friendly and governance-friendly investments, a win-win for sub-Saharan African countries and investors alike. Of course, one should avoid generalizations about private sector behavior, since different investors, of course, have engaged differently with countries in the region. That said, I think a few conclusions are still in order. In the past, foreign investors were rightly hesitant about making long-standing, long-gestating, and costly investments amidst political and policy uncertainties. The enabling environment still requires significant improvement in some countries, but overall, it has evolved in a positive direction across the region in the past 2 decades. Likewise, as pointed out earlier, the instruments and other support being made available to investors by MDBs or DFIs and bilateral agencies to manage risk have increased. I believe that investors can and should therefore respond to these positive developments by contributing to further improvements in the enabling environment in 4 ways. First, in recognition of their own survey-based feedback that infrastructure rather than taxes is the most binding constraint, investors should resist pressing for base-eroding tax exemptions. While it is reasonable for them to request well-targeted incentives that directly reduce the cost of capital, open-ended and profit-based tax holidays are less effective and can cause long-term erosion of the tax base. Second, investors should likewise only make use of guarantees and other risk-mitigating instruments provided by MDBs and bilateral agencies when truly needed. By so doing, they can help avert excessive guarantees and moral hazard that could result from the Compact with Africa and other blended finance initiatives. Third, investors can best support institution building and good governance critical to quality investments by maximum transparency in their own operations, and by strictly abiding by a country's public financial management laws, revenue code, and regulations, as well as the roles of key ministries, like the Ministry of Finance, in negotiating and monitoring their agreements. Investors can consistently demonstrate their desire and respect for stronger institutions. Finally, with some countries, reluctance to accept the private sector's key role persisting in some countries, investment in more outreach can increase local communities and civil society organizations' appreciation and be used to effectively solicit their views and concerns about proposed or ongoing investments. So colleagues, ladies and gentlemen, I've covered quite a bit of ground this morning, focusing mainly on some remaining policy challenges for sub-Saharan African countries and on action needed from the region's development and private partners, with the view to ensuring that investments are indeed of the highest quality and do indeed fuel growth. I trust that my remarks will provide a good introduction to some of the issues you'll be taking up during the rest of the day. And I very much look forward to your comments and questions. Thank you very much for your attention.
Thank you very much. That's very, very interesting. If you can talk a little bit about what can other developed countries such as the United States, the European countries do to learn from the China One Belt, One Road initiative. What's working there for Africa and what can we learn from them? Thank you.
Well, I'd say it's early days yet to draw lessons from the One Belt, One Road initiative. It's just taking off, it's starting to take off, and certainly there are no concrete examples of what has been produced from that in sub-Saharan Africa to draw lessons from other partners. But there's been a call for a very long time from policymakers for certainly more attention to infrastructure, and that has been heard, I think, by many partners. I spoke earlier about some of the adjustments that have been made to the debt limits policy in institutions like the IMF to try to accommodate countries' access to more non-concessional financing while managing debt sustainability. But that's one responsiveness that has been there. There are countries like this one that have invested considerably in Power Africa and trying to respond to a need for electricity in sub-Saharan Africa, which is huge. And so I think it's too early to comment on the One Belt, One Road, but it is indeed encouraging that across the board you see quite a few initiatives on infrastructure responding to what countries have been saying for many years.
Well, I'll ask a question and then and then have Ritu go. So you've had the advantage of seeing this from both sides, as a development partner side as well as in the finance ministry. And what can you tell us about the constraint that each side faces, which being able to see both helped you? Because I've often heard people say, the World Bank, the IMF, they don't understand the constraints we face. And I've seen it in my country, in India. But having seen it from both sides, what can you tell us? Thank you.
Well, I think one thing that is not talked about very much in terms of the ability of both sides to maybe adapt how they're operating and interacting with each other is the political economy context, or the political context in which both sides work in. Of course, at the level of the country authorities, Minister of Finance and other ministers who are struggling to push the reforms that they consider to be the best course of trying to get to that growth that everybody wants. There's a lot of politics around what the ministers of finance can or cannot do. And I think adapting and understanding to those politics is really critical for the international institutions and partners out there to understand a bit better than they have in the past. But likewise, I mean, IFIs in particular, and bilaterals as well, do have their own politics that they have to adjust, work within and adjust to. And there are times when in the IFIs in particular, there are clearly very strong technical views of what is a better course of action or a more adapted course of action to a particular country, but where there are many pressures from the board and others that have seen experiences in other countries that want to see so-called even-handedness sometimes applied in the policy prescriptions that those institutions give to countries. So it's a matter of really understanding the politics of institutions, understanding the politics of individual countries, and trying to work with those and trying to get enough of a groundswell in terms of changing how those politics constrain better choice of policy prescriptions. I think that's one lesson, certainly from my sitting on both sides, that I think a lot more work on political economy issues is important. Yeah.
Thank you for your presentation, Dr. Sayeh.
You're very
I have a question which is just peripherally related to what you presented, but I would love to hear your thoughts on it. It has to do with the social sectors in Africa and particularly around education and health. What do you see as the role of aid or investments by private actors or government investments in helping these two sectors advance across the continent, given that there's so much heterogeneity across different countries in how sophisticated these sectors are? Thank you.
Indeed. I can't say I have a huge amount of expertise on the sectoral issues, but I certainly know that the constraining factor of limited fiscal space is an important one. And of course, in not just recent years, for many years, international financial institutions have tried to help countries work on that. There was the whole experience of the HIPC period, for example, where resources saved from debt relief, of course, were targeted on education and health spending, and monitored, and where targets for social sector spending continue to be monitored in, say, IMF programs for countries. All of that is helpful potentially, but it's just one step. It's just one step of trying to make sure that more resources are available for education and health. But of course, the choice of what types of education interventions is an important one, and what makes for high-quality education or high-quality health services. Perhaps not enough attention, well, certainly from the World Bank, a lot of work on that, but it's not enough to focus just on making that fiscal space. It's really important to go beyond that and help countries select the highest return investments in those areas. And of course, make those investments sustainable down the road. The private sector, I think, increasingly we've seen a lot of private funding of interventions in the social sectors, of course. Not just humanitarian, but foundations over a long period of time working with African countries to help them. That is a very positive, relatively new development that I think countries like the one I worked in, Liberia, certainly benefited quite a bit from in that immediate post-conflict period, too, where there was a significant transition to be made from resources made available by humanitarian institutions in the wartime period to more development financing, which couldn't come on stream quickly enough relative to the needs because of huge arrears that Liberia had to IFIs at the time. And interventions from private actors was hugely important and very helpful in those days.
Dr. Sayeh, I would like to thank you so much for your leadership in promoting the idea of having a sound financial policy in Africa for government to be able to support their long-term economic goals.
Thank you.
And you did that particularly in Liberia during a very challenging period of time. I'm an entrepreneur for a long time. Mm-hmm. I would like to express the voice of the voiceless, yes. An entrepreneur in Africa, in constructions and other stuff, developing businesses. And I am based in the U.S. to try to assist U.S. companies doing international, but especially to Africa, a better understanding the market there and the cultures and environment. There's something that I didn't really quite understood from your comments, because you keep on stressing on that, raising taxes. The level of taxes is not enough in Africa. If you think that Africa, to reach the economic goals, they need to attract more foreign private investments, how do you think that it will be really consistent in Africa to both raise taxes and to attract more international investment at a time where, as you know, all countries around the world are trying to lower the taxes? So don't you think that it should be something that we should just be very careful about promoting that, rather than to doing harm into the main goal, which is, in fact, building growth in Africa and not just raising taxes? Thank you.
No, thank you for that question. I think to answer it, it's important to clarify that I was talking about raising more revenues, not necessarily raising tax rates to get that revenue. Certainly, there are lots of potential for raising revenues by simply collecting what is on the books and what is already mandated by the revenue code. It's not a matter of simply just jacking up the corporate income tax rate. It's a matter of better managing how you grant exemptions, if you're going to grant them at all, what types of exemptions you grant, not open-ended tax holidays that are never scaled back and that really undermine your revenue base, for example. It's a matter of being more systematic about the conditions under which you give exemptions and the process for doing so that is transparent and that is not, one minister just passing some exemptions somewhere. Those are the types of things I think significant potential for revenue for really better managing tax exemptions, which are huge in sub-Saharan Africa. And if you ask, as I was saying in my remarks, if you ask investors, and quite a bit of survey research asking investors what really constrains their investment, they don't say it's taxes necessarily. They say it's an infrastructure. How in the world are the authorities going to build infrastructure if they don't have a tax base? That's a problem. They can't just borrow to finance infrastructure. Certainly they need to combine sensible borrowing, but also with higher revenues to be able to finance infrastructure. So that's the balance. No one is, suggesting that countries go after completely, taxing out the private sector. They're certainly not going to get what they intend to in terms of, willingness to invest if they look so unattractive from the tax perspective. So point well taken, but I was not trying to suggest that countries just jack up their taxes.
Hi.
Hi.
I have two questions, and this gentleman actually kind of touched on one of them
Okay.
in terms of taxes. I won't ask that question again, but just as a comment, I think if taxes are lower on corporations, then that would create opportunity to create jobs where at the same time individuals are paying taxes, then that would generate revenue for the government as well. So I kind of agree with him for entrepreneurs, for outside investors from the US, for example, or other countries coming in. I think taxes are very important for them because, again, the risk is high. Of course, they're asking for high returns, but they also by coming in and investing in African countries, they're creating jobs which would eventually would generate higher revenues. Now, the other topic I wanted to touch on, you mentioned mobile banking, and I've talked to a lot of people who do business in Africa, and they said the actual growth of mobile usage and mobile technology has helped a lot of growth and access to financial resources and so forth. With cryptocurrencies that are becoming very common in third world countries and growing countries and so forth, growing economies, do you see that as a risk to individual investors, to outside investors, to private investors? And how does that come into play? If is it going to have a positive impact on the economy and investments, or is it negative in terms of the tax revenues for the government again? The transactions that are happening, regulations on cryptocurrencies. I would think that it's going to help a lot of people to have access to finances again because it's transactions, no-fee transactions between individuals. Easier access to finances, but at the same time, it's harder to track. So is that additional risk for investors? Thank you.
Yeah. No, thanks for that question. I can't say I know enough, a huge amount about cryptocurrencies to really, answer your question fully on that. But clearly, you pointed out the risk that there would be from that type of currency if the regulatory capability, the monitoring capability of countries are weak and their ability to actually know what's going on because of that type of operation is impaired. And so just as mobile banking, I think, has shown that some adaptation of the regulatory framework is necessary to maximize the contribution of mobile banking while really containing and mitigating risk from it. I think countries will also have to carefully look at their own regulatory environment to see how best to benefit from cryptocurrencies.
Hello, my name is Janaba Sayeh. I'm a recent graduate here at the Smith Executive MBA, so very excited that my former professor Kisler invited me. Okay. So I was in banking for a long time, but after graduation now I have my own company.
Okay.
And I'm in the diaspora. As we know lately in the African diaspora, there has been a lot of involvement whether it is through social media or through democracies that are emerging right now. There's been a lot of contributing factor.
Yeah.
Where I'm from, the Gambia, that has been a big factor to the most recent government there.
Yeah.
So my question that we have is, most people in the diaspora try to do investment into our, our native countries. But the challenges sometimes we have is try to work with the government. And sometimes going around the government could lead to some private investments that are not sustainable. Being a former finance minister of Liberia, how would you advise those of us here in the diaspora try to make those changes that will be a lasting impact? Thank you.
No, I think you've really underscored the huge potential there is for countries to benefit from their diasporas, and certainly that's the case for Liberia, which is very dependent on remittances from the huge diaspora created by the war. And there's a lot of interest currently and a lot of looking into how to actually encourage the diaspora to engage more, and what sort of operations and what sort of changes are necessary, and how in certain areas to allow them to do more. Work in progress, I think certainly the diaspora people have to, I think, link up with people who are on the ground and who know the ins and outs of what is happening, to be able to put together a sensible, proposal, and have to keep their eyes very close to the ground in terms of the policy and regulatory developments, what may make for a profitable investment or not, what exactly they need the authorities to change to make their investments more productive. And so I think a lot of investment in just an analytics about what is happening on the ground is really important, to be able to have your foot into the authorities too, in terms of what they need to do to change. I know it's easy sometimes when one is in the diaspora to throw darts at at authorities. Certainly that was the case when we were trying to start in Liberia as well. Everybody thought that they knew best how to get things going. But things can look very different when you're there on the ground in the middle of it all. So I think it's really important to have that closer link. Yeah. Oh, okay. Thank you. Thank you.
No, please stay here.
Thank you.
I have a gift for you, and then we'll have a present. Let me formally thank you so much for this really enlightening session, and thank you for the discussion after that. We have a gift, and I think it'll photograph better if you can come here. So, thank you so much.